Well, hello everybody. Welcome back to another YouTube video, and this is gonna be a special YouTube video because in this video I'm gonna be showcasing external ICT for the first time on YouTube. But before we get into it, I'll just have a quick disclaimer and say that everything I say in this video I've learned from the Theinnercircletrader, and everything is based off of ICT concepts. What I mean by this is simply put it that you can go to the primary source, the Theinnercircletrader, and I highly recommend you all going to his channel, checking out his YouTube channel, because it's there which I've learned all of this and learned external ICT on there. But in this video I'm gonna be putting the ICT concepts and putting my market experience and showcasing both of them together and what I've learned, what my experience with it, and how I've evolved external ICT. So let's just get right into it. Simply put, what is external ICT? External ICT is everything you can't see in time and price. What I mean by time and price. Time and price explains one market. And on all the different markets, you have the same time but not the same price. What I mean by this is simply that while you don't have the same price, you still have the same time. And the price is moving differently on all the major pairs and all the major markets in the world. I'm gonna state pairs just because I'm an FX trader. But this we can use as an advantage. And we'll get into that advantage. We can utilize it later. Anyways, time, what I mean by time is simply kill zones, quarterly theory, etc, etc. Price, PD raise, fair value gaps, order blocks, and also buy and sell side liquidity. Okay, this is the thing which I used to call, or which I'm calling, internal ICT, and it's essential to apply it to the external factors. Before I go and talk to about external ICT, I'm gonna ask you the question: is influx of liquidity random? So what is external ICT? External ICT is the underlying dynamics of external ICT is that correlation combined with time and price theory leads to higher probabilistic outcomes in the market. Simply explained, like I told you guys before, we have time which is same on all the major pairs, markets, depending on what you trade. If you're trading indices, Forex, etc, etc. So what the different things is that the price is different. Like I told you, price is different, and what we can utilize it, how we can utilize it, is simply because there is different liquidity structures on all the major pairs. They will react differently, but the thing is they are correlated, and during these moves we can see where the money will transfer from which market to which market and how the IPDA operates. Okay, this can help us tremendously because now we can see what is gonna happen, or what is most probable to happen in the near future and in the long-term future. And this will just give you such an immense hindsight into trading. And I'll go right into it. So, first things first, I utilize a thing which I call the DXY correlation. Why did I choose the DXY? First things first, it's the world's reserve currency. What that means is simply a simple definition of a world reserve currency is simply that it's the number one used currency in the world. It's the most used while also being the strongest. What I mean by the strongest is that all the central banks of the world hold a reserve in the DXY or in the American dollar. What this means is that it's so strong because all the major central banks have a part of have the money or store the money dollar, and it's so highly used. It's pegged to oil more or less. There is some exceptions. It's pegged to gold more or less. There are some exceptions. I'm not meaning pegged. I'm meaning when you buy gold, you buy with American dollars. And when you buy oil, you buy from with American dollars. You should look at the statistics and also look how much dollars all the major central banks holds. And when it comes to central banks, you know they are really important when it comes to the IPDA. And I'll not go so into it. I'm just telling you. So, the DXY or the dollar, I'm gonna refer to it as the DXY from here on forth, just because the DXY is the dollar index, the American dollar index. So it reflects the price of the dollar. But the dollar is also a safe haven currency, and it's also a safe haven currency because of its characteristics, because it is the world's reserve currency, and also because United States has a major influence over the world and its economy. Because the United States is the world's biggest economy, it is the driving force of the world right now. It has the biggest army, and it has a global influence over the world. And I'll not go right into history now, but I think you should look it up if you don't know, because it's really important for you. And let me just explain risk on, risk off. So risk off is simply when the DXY rises. When the DXY goes up, everything else goes down. So dollar up, currency down, commodities down. They have a harder time going down, but there are some underlying dynamics of commodities which may cause them to continue higher even though the American dollar continues higher. One, because they are also a safe haven currency. So for example, if you're experiencing a crisis, the gold might go up and also the dollar might go up at the same time, even though they're opposites. Indices and derivatives goes down when the DXY goes up. That's usual. They can go up, but that just tells you that they are manipulated, really manipulated, and that you should more or less stay out of the markets. Yeah, and you can also say that when risk off is happening, the world is experiencing a bad economic period. What that means is that the world economy is not in its best shape, and that you more or less are gonna see some economic stagnations, because there could be many reasons, but often when the American dollar rises, it's often due to interest rates. Interest rates is due to inflation. That's just one example. It could also be caused by a crisis or by other factors. But when the DXY goes down, that's where the business lies. So when the DXY goes down, that's when you're gonna see other currencies go up, because the money is transferred to the other currencies. What that means, that's why it's called risk on, because it's a risky, because risk off means the central banks feel like it's not as risky holding American dollars compared to other world currencies and assets. And when it's risk on, that means that the transactions go through many, or go to more riskier assets. That means that the currencies goes up, DXY down, currencies up, commodities up, derivatives up, stocks up, all of that. Yeah. Now let's just go into how I utilize the DXY now. So how it can help you, how it can help us. Number one example is that it can determine when market conditions are good and when they're not good. For example, when the DXY is consolidating on a high time frame, that would indicate that the transactions going through the IPDA is really slow. There's not really many transactions going through. There's no trending markets then. There's no central bank switching money. They more or less stagnate there and hold their American dollar and don't transfer it through, and don't accumulate more, or transact it to other risk on currencies or risk off. So they're like net they're net neutral. Consolidation on the DXY would mean that all the major other currencies correlated with the DXY, so all the major American dollar pairs, will also be consolidated. So that simply means when the DXY is consolidating on a high time frame, you should stay out, and you're gonna see a bad market period for trading. You can see here, Tuesday, 26th of September 2023 to Friday, 3rd of November 2023, we were consolidated. Same thing happened on Euro USD. And check out these on other US current or other US correlated currencies, like other pairs, other major US pairs. Anyways, example number 2. It can clearly help you determine a better bias drawn liquidity and order flow. So right here, it's not always clear on that pair you're trading where it's gonna go. Well, now you can use the DXY. You can use the DXY as a tool to determine where it's more likely to go. Or if you see for example, market maker model, you will see it more clearly on the DXY. It will be more clearly defined. And now I'll show you a better picture of it. So right here you can see Euro USD. Here, Friday 8th of December, we got the drawn liquidity right there. This is the original consolidation on Euro USD. This is the original consolidation on the DXY. You can see the market maker buy model much clearer than you can see the market maker's sell model on Euro USD. What that means is that you can utilize the DXY because you know when the DXY goes up, Euro USD must go down. Okay? Because the DXY is much stronger than Euro. Okay? DXY up, Euro down. Because it's the Euro against the dollar. You can see right here. Here's the drawn liquidity. Here's the drawn liquidity. You can see it defined much better on the DXY compared to Euro USD. What this means is that you can find the order flow much better, the bias much better, and also the overall market structure much better when you utilizing the DXY in combination with Euro USD. Anyways, future projections. This is a thing which I've done myself, and I'm gonna showcase it to you, and I've kept secret and only showed to my students. This does not always work, so I have to take in consideration, but it becomes more probable when it have happened. When it does, it's really useful. And this is a lower time frame usage. There are many other lower time frame usages you can use for the DXY, but this is one. And I think you all should try it and then tell me what do you think. Going back to Euro USD here on the left and the DXY on the right. You can see the drawn liquidity Friday 8th of December, drawn liquidity Friday 8th of December. You can see it's much clearer defined, but that is not what we're going to look at. You can see same drawn liquidity, same time we got the drawn liquidity, everything is the same, right? Going into here, we have still the Euro USD. This is the last chart I showed you was on the weekly. This is on the daily charts, or 50-minute chart. I'm sorry, guys. So we had the same drawn liquidity here and here. Simply what happened is that you can see the DXY on the right chart, but what happened on the DXY is that it took the drawn liquidity much earlier than Euro USD took the drawn liquidity. This is a future projection because now you know that the DXY have taken the drawn liquidity. You can see it took the drawn liquidity Monday, 5th of February 2024. This is a really new example of it. 11:00. Here's the exact same time. We are here. We know the DXY have taken the drawn liquidity. What we can expect from Euro USD is also that it takes the drawn liquidity. We have a really high confidence just because the DXY have taken the drawn liquidity before Euro USD. Simply put, that you can get a really nice free trade off of it because you know it's correlated and you know Euro USD have to follow the DXY. So you know it for a fact it has to take the drawn liquidity. And this had not happened yet. So you could simply just take this CB free trade down here, and it's nearly always happens. And I think you all should try it and then tell me. Really interesting, right? Now we go to the second thing in external ICT. This is market correlation. What market correlation is simply that you use different markets in specific sectors to look at the correlation between sectors. A sector could be a commodity compared to a commodity. It could also be a pair compared to a commodity. It could be an indice compared to a pair, or another market compared to another market. But you're looking at the correlation between other markets and not compared to the DXY. Because if it's compared to the DXY, it's DXY correlation. This works because you have the risk on, risk off dynamic. What this means is they're still correlated, because this only works with correlated pairs of the DXY. Otherwise it will be like a little bit more complicated, and I can go into it in another video. I can start explaining it. But I'm gonna tell you how to use it when trading the FX market, Forex market. And I'm also gonna tell you to trade on your markets. I'm gonna give you some examples how to use market correlation. For example, if you're trading Euro USD, you should look at GBP USD, compare the two different markets, compare the prices, okay? And when you go into a specific time, compare what have happened. Compare what happened on London Open. If this is an example, if GBP USD, I'm going to give you this as an extra, much more of these, goes up, Euro USD goes down, the DXY goes down as well, following GBP USD. What can you expect the Euro to do? You can expect the Euro, for a fact, to continue higher, because that's just a manipulation lower. Because you have the confirmation that GBP has gone higher and the DXY has gone lower. Euro can't go against that, because you see the transaction in real time. You see that money have flowed from the DXY to other pairs, to other currencies. The other currencies will then go up. You should also look at USD JPY, compare it to Euro USD if you're trading Euro USD. This also goes for GBP USD. So if you're trading GBP USD, you should look at all of these four, plus the DXY, of course. And if you're trading a commodity like gold, you should look at silver and also Euro USD and the DXY, of course. This goes if you're trading silver as well. Look at all of these. If you're trading Nasdaq, an example, you should look at the S&P 500, Dow Jones, compare the different prices, and also Euro USD as a comparison. For example, Euro USD should follow Nasdaq, it should follow Dow Jones, and it should follow S&P 500. When they are uncorrelated, you can see that it's usually bad market conditions. I'm telling you, because it's really useful. How it helps? It can help you determine good market conditions when they're not good or they are good. For example, here, same thing. This is also some future projection, and I have future projection. I'm gonna show you future projection, and this is an example of future projection as well. So you can see here on AUD USD. AUD USD started stagnating off, started becoming much more consolidated Monday 21st August 2023. We still had good price action on Euro USD, continuing lower. But then we started getting consolidation at the bottom. Right? Now, let me tell you, we have already seen a consolidation here. What date was this? Go back and look at the DXY. And what could you have already expected Euro USD to do later down the line? You could already expect it to consolidate, because you can see the other pairs consolidating. If the other major US pair is doing a thing, and that pair you're trading is not doing it, it's going to do it. Future projection, another future projection, which I'm going to show you, another example. Does not always work, of course. Not everything has 100% win rate, but it does work really well. And it's really useful when it happens, of course. This is also an example of lower time frame usage using market correlation. Try it and then tell me. For example, here you have Euro USD right here and AUD USD. Like I told you guys before, as an example, Euro USD, you could just see pumping for the entirety of the day. But the euro dropped sharply at the beginning. You can see it started correlating first here as the AUD followed. Then we got a big drop in euro. But AUD continued higher. What could you then have expected on euro? Yes, you could expect, because if you're also comparing the DXY with this and some other markets, and the other markets also showed you it was willing to continue higher, and the DXY continued lower, you could already have expected that the euro should follow the correlation between them. Okay? So you could have expected this whole move, and you could have expected that this was just a manipulation, and that it should have followed the other correlated pairs. Anyways, you guys, that was it for today. Hopefully this gave you some hindsight into what I'm doing, and also some hindsight into what you can learn with this. I'm not gonna teach you the full extent of it. Instead, I'm gonna tell you to just go in the charts, back test this, go into a deep dive into this, and then you guys tell me what you think. If it works good, you can use it. If it works bad for you, don't use it and stick to one chart. But this can be applied to any model and any strategy out there to increase the hindsight. Thank you for today, and thanks for listening. Bye.